Welcome back, everybody. We are back for another edition of Deb Talks with the one and only
Deb Owen
and Lupe.
Right. And this week, my buddy's back. Yay! I missed her.
I'm back.
Yay.
I missed you guys. I missed you.
Sure.
Right.
Right.
Okay, I missed you. And then I
Thanks.
missed you guys.
Yes.
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 In that order.
Yes. Okay. Yeah. Very good.
Yeah.
Anyways, this week, what we want to talk about is refinancing.
Mm-hmm.
Because we need refinancing isn't always a bad thing. We need to understand what it's about, why you would do it, how it works,
and when it works.
Yeah, benefits to it.
When does it benefit me?
Right.
Yeah.
Because sometimes it doesn't, and a lot of times it can.
Yeah.
Okay. So really, I'm just going to just dive into this. Is that okay?
Yeah.
So there's really two basic types of refinances. Not really, that's what there is. Two.
Yeah.
You can do what we call a rate term refinance, which literally means you're just refinancing the existing balance on your first mortgage into a new mortgage interest rate. Okay, so right now, obviously, that might not be the best loan for anybody because a lot of people have a lower interest rate. And so a rate term refinance might not be beneficial. And then there is what we call the cash out refinance. And a cash out means exactly that.
Yep.
Is you're going to be taking some cash out. And the thing about a cash out refinance that you need to understand too is the fact that even if you have an existing first mortgage and you have a home equity loan or a home equity line of credit that you got at a different time than when you bought the house, you have it on the home right now. But if you didn't get that line of credit or that second mortgage at the same exact time you bought the house, then that's still considered a cash out refi.
Yeah, because you're taking money to pay off that debt that cannot be avoided. It must be paid.
Right. Yeah. So that's the definition of cash out. And that's what you've got. You've got two choices when you're doing that. But what's the benefits to that, right?
Yeah.
Again, a rate term would be the obvious to lower the current interest rate that you have, refinancing that current principal balance and getting a lower monthly payment. So that's a rate term refi.
And also changing your terms. So that's a rate and term. So,
correct.
Right. So you can change also, like if I had a 30-year before and now I want to look and see what a 15-year would look like for me, we can look at that.
Or vice versa. We've
vice
had
versa, exactly.
Folks that had 15-year terms and payments on a 15-year are typically a little higher. And with the economy right now, that was a struggle to make those. So we can do a rate term refi to change that term and extend out that term, therefore lower your payment.
Yep.
Okay. So that really is by definition, well, that's what a rate term refi is. It lowers that interest rate and changes your monthly payment. The cash out is accessing the equity in your home. And it can be to then cash out to pay off an existing home equity line of credit or a home equity loan you have. Because a lot of times the home equity line of credits are prime plus something, and the payments are interest only payments. So a lot of times people don't even start paying down the balances of those equity loans or equity lines if they're just making the minimum payment. So it can make sense to go ahead and pay that off so that you can actually start hitting the balance on that home equity line that you have.
Correct. Yeah.
It could be for any reason. I mean, you can want cash out to update your home. We're doing a lot of
several of those. Yeah.
Right. It can be consolidating debt. And right now that is what we're seeing.
Yeah.
That's actually what we're seeing most refinance at right now is to consolidate debt. Because interest rates on credit cards are really at an all-time high.
Yeah.
And it's hard to make sometimes the minimum payment on those credit cards. Whereas if you have some equity that you could go ahead and take as a cash out and pay off those credit cards, and you're further ahead.
Yeah. Yep.
And yes, an interest rate on a cash out refi, and that's something we're going to touch
Oh, yes,
bases
as
on,
well.
is,
Yeah.
because you've got to know the ins and outs of a refinance.
Yeah.
And I'm probably jumping way ahead here, which is typically what I do, right?
Well, I think it's
Sorry.
just one of those things that people, as we, you move forward with explaining it, and the concern, and
Right.
that's one of the
It's like,
big concerns.
okay.
Yeah.
If today's going interest rate, and this is not it, and just so don't listen. I'm not quoting anybody.
This is an example.
This is an example. Yes. So if today's interest rate on a 30-year fixed rate mortgage on a purchase is say 6.625, if you're doing a cash out, you're probably going to be at 7.125 or even 7.25.
Yeah.
But let's do the numbers, because that's still better than 21%. Or we've seen several credit cards closer to 30% on credit card balances that you're not even touching. So even if an interest rate seems a little bit higher on those cash outs, a lot of times it's still much better for you to do something like that and pay off those credit cards and get out from underneath that credit card debt.
Yeah. And then just have the one payment, just your mortgage payment.
Right. And we can save, I mean, we can save thousands of dollars by doing that, using that equity in your home. And the other thing, by using the equity in your home, you're going to be able to write that interest off on your taxes.
Yeah.
Between your first, I mean, I can't say you always can, but at least you can potentially write that off on your taxes versus the interest that you're paying on credit cards or auto loans. I mean, auto loans are 8.5% right now, 9% right now, above 10% right now. And that's just life. That's just reality of everything. So if you can even pay off an auto loan, pay off RV loans, we're seeing a lot of RV loans that we're paying off, recreational vehicle loans, just anything like that actually will save you overall in the long term. It could make very much financial sense. It might sound like at first, oh my gosh, but when you actually put it to pencil and start diving deep into the numbers, it can make sense.
Yeah. And that's what I like when you say putting it to pencil, because we love to review the numbers and show where it could make financial sense. Exactly.
Right. I mean, if it does not,
yeah.
I just did one last week for a gentleman. It made no sense for him to do it.
Yeah.
None. So we worked up the numbers, we went over it with them, and obviously what he's got and where his situation is, it was better for him to stay with the credit cards he had and the mortgage that he currently had, financially speaking.
Yeah.
So it's not always going to be, but at least we'll put it to number, because you would be surprised how many times that really can relieve.
Yeah.
And I will tell you this, it will absolutely save you thousands and thousands of dollars of interest, even over a short-term time frame of maybe say 5 years that you have your credit cards. And if you're even at an 18% for 5 years on a credit card, it would still save you thousands and thousands. But that's what we put together for you. So you have to know the ins and outs.
And with the refinance, then do I have to worry about coming and paying money out of pocket? I mean, for either example, with the cash out or with the rate term. Do I have to have a certain amount of money that I'm going to have to put down right away?
The goal is always to not have the buyer or the borrower come in with any money out of pocket, right? That's always the goal. And most of the time it can be done that way. Yes. Okay. But that's going to depend on the equity that's there and what we're using.
And how do we know what the equity?
So
that's
perfect.
Yeah.
Perfect.
How much equity do I have?
So
how do I know?
On a rate term refi, depending on the loan, you can go as high as 96%, actually just a little bit higher than that, on a rate term refi of a new appraised value. Okay. So your value of your home, and then we are going to do a refinance. We can go up to like 97. It is 97% on one of the loans. And depending on the loan is depending on what your equity position needs to be at. But most of the time that will be enough to cover what you owe on it and what the refinance cost is. And we're going to come down to refinance cost in a minute, because this is what's also very, very important
Yes.
to understand about a refinance.
Yes, correct.
Okay.
Mhm.
And then, of course, if you're doing a cash out on VA is the only one that will allow you to go to 90% cash out on a new loan. Okay. All the other loan programs will maximize your cash out at 80%.
Okay.
So you get a new appraised value, and you take 80% of your new appraised value, and whatever you owe on your current mortgage, we take out of that. And then the difference is what you can take back out in cash to do all those different things that we talked about.
Okay.
Right? Pay off credit cards, pay your child's college tuition, buy a car, do updates on your home, whatever the reason is. You can take that difference out. We will, so actually where this came by was the question on the cost. What we will do first is we will take the cost to do the refinance out of that too, and that is the difference that you can get to pay off credit cards or do anything. So I apologize, I did speak on that part.
Okay.
So typically speaking, you shouldn't have to come up with any money out of pocket, but that all depends on the equity position.
Okay.
Okay.
Yep. So really, once you know what your equity is,
right,
calculate out how much we're going to need
to pay off your first mortgage,
and to pay off the first mortgage and the fees. Then what's left over is what you could potentially tap into.
Right.
Okay.
Right.
Yeah.
And
do I need to order an appraisal? Do I need to have an appraisal?
Most of the time on a cash out, the answer is yes. Most of the time.
Okay.
It is going to actually depend on the loan type and if we can get what we call an automated appraisal waiver.
Okay.
And none of the government loans will allow for that. Okay. But if you're looking at a conventional loan and you're low enough value, we do see that we get appraisal waivers.
Yeah.
Even taking cash out. We get a lot of the times we can get appraisal waivers on rate term refis on a conventional loan. So it's just going to depend on how strong that overall file is to start with, on whether or not you're potentially going to get an appraisal waiver.
Okay.
We always go in assuming we're going to need an appraisal.
Yeah.
We always go in saying, okay, what, Mr. Borrower, do you think your property is going to appraise at currently? And it's a shot in the dark a lot of times.
Yeah.
I mean, we can do our best educated guess by doing a little bit of research, and we do a little bit of research first to see potentially where it might come in at, and obviously have those conversations with our buyers, our borrowers, and say, hey, do you think this is accurate
or not?
You know,
I know that there's some people that have asked me, well, is there anything that I can do before you order the appraisal so that I know how much equity I might have? Is there any, because this is a lot of our borrowers go off of the property assessment from the taxes, and that is by no means what you should go off of.
Or
as
Zillow.
And
Zillow isn't right.
And Zillow isn't right either, right?
Because Zillow's just pulling data.
Yeah.
You know, I mean, that is a hard one. Obviously, you know what you paid for it.
Yep.
If you did anything with it the last couple years to have an appraisal done for any reason or whatever, you know, that's always your starting point. Just because the house down the street is on the market for $500,000 doesn't mean yours is going to be worth $500,000 either. So there's just different. It is kind of hard, but I think most people have a good idea of what their house value at least can get around, and that's the starting point. I mean, that honestly is. If you came to us and said, "Hey, I think my house is worth XYZ," and we worked up numbers and it didn't work, why go forward? Yeah. Right? I mean, why go forward if it didn't work if you're telling me, okay, I think my house is worth $400,000 and we need it to appraise at $420,000 or $450,000 for it to make it work. That what you want to do, we're going to tell you that. You know, it's still your choice, because if you do want an appraisal, then obviously we're going to charge for the appraisal on that. Don't get an appraisal yourself. If you as a homeowner get an appraisal, it is worth nothing to any mortgage lender. Sorry, that's just the facts. Yeah. It has to be ordered by a mortgage lender that is for their third-party company validations. So don't go and get your own. work with us. We'll see what we got there.
Yeah, we'll guide you through that process.
Yeah, we'll guide you through that.
Mhm.
On refinance, I'm going to come back to cost because that's the biggest one.
It is.
Okay, that is the biggest one. It
Mhm.
has to make financial sense. But also mortgage rates. So are mortgage rates the same on a refi as it is on a purchase?
Yeah.
Are they the same, depending, and that's the thing is mortgage rates on a refinance, and you just heard me say that a minute ago, probably a few more minutes ago than that. It depends on, so a mortgage rate on a refinance depends on again, a credit score. Always, always, always depends on that, no matter what. But on a refinance, depends on a credit score. It depends on your loan to value.
Mm-hmm.
Okay, so your mortgage rate is going to determine, am I at 80% loan to value or am I at 60% loan to value?
Yeah.
Okay, so that's a factoring. And of course, if you're doing a rate term or if you're doing a cash out, because a cash out is always going to be higher in an interest rate than a rate term or a purchase. Okay, you can always buy points again and do that kind of thing, but generally speaking, an interest rate on your cash outs are very much subject to those bulletin points that I just went over.
Yes.
So again, you've got to know your numbers to make sure we know if it makes sense to do that refinance. Okay.
Yeah.
And then the cost to do refinance.
Then the cost.
Right. Because it does cost. It costs to do a refinance.
Yeah.
No changes. I mean, no ifs, ands, or buts about it. Even if we currently hold the mortgage, it still costs to do a refinance. Yeah. So if you need an appraisal, there's a cost there. We have to pull an updated credit report. So you got your credit report fees, you've got your standard flood fees, your tax certification fees. You have all the standard fees involved in a refinance that you do in a purchase. The difference being in a refinance is your escrow fees, your closing fees with the title companies. And it is what it is. Because and again, when we're putting numbers together, we look at that to make sure it still makes sense. Because on a purchase, you split those costs with sellers, believe it or not. On a refinance, we still have a closing fee with the title company. It's still calculated the same way, but there's nobody to split that fee with. So you as the homeowner pay the entire amount. And then title insurance must be updated.
Yeah.
Even again, if we have the loan. And the reason is because we have to go back and you have to do a new title search on the homeowner to make sure that nothing is attached to the property that would come in presence of a new mortgage loan. Because even we're refinancing our own, that current mortgage that we have gets recorded as released and we have to file a new one with the new numbers, right? And if there's something in there that would stop or be put in front of it, it has to be addressed.
Yeah.
And those could be things like tax liens, child support liens, typical medical liens. So, or if you do, there were people that had forbearances during the COVID and came out of that forbearance. There might be a portion of that was put back on the back part of your loan. That's not a lien. Well, it is too. It's a lien.
Yeah, it is recorded that way.
So we have to get title insurance updated. And when you are updating title insurance, you have an owner's policy and the lender's policy. Again, when you're doing a purchase, that owner's policy pretty much falls all on the seller. And that's the biggest portion of it. And when you are doing a refinance, you pay both portions of that. So there's those costs are there. Now we can get discounts for lender fees, and typically we are right now on refinances. Well, sort of. It depends on the kind of loan we're doing, whether we can do that or not. But anyways, those are the costs involved.
Those are potential things that could be looked.
And then your escrows, your impounds.
Yep.
Okay. You have to start those over again. Now, if we service the loan, we can roll your existing escrow into the new escrow account. And so though that amount could be considerably less
Mhm.
But if we don't service the loan and we have to recollect, it depends on when your home insurance is due again and when your property taxes on how much we have to collect. Because we have to
Yeah.
make sure that when those are due or due and payable, we have enough money again in that account.
Yeah.
So example, sometimes we're going to have to collect 14 months if it's due and
Oh,
payable
yeah.
now. Sometimes we only have to collect
Mhm.
3 months. So that's the hardest part to gauge, but we ask some questions so we can get the best information there.
Yeah.
The good news is, I know I'm just going off, aren't I?
No, well, you're getting the information.
Well, I'm like
Yeah.
thinking about it.
I bet in when I need to
The
butt in.
good news is, um, if we don't service your existing loan and we're paying that off,
Mhm.
once your loan does close, and I always tell my clients at that point, it's like, go find out what's in that escrow account right now. Because once we close on a new mortgage and we pay that one off, the amount that's in your existing escrow account is going to get refunded back to you in the form of a check because they can't hold that. The mortgage lender, if it's somebody besides us, and we're not rolling them over, the mortgage lender cannot reduce your principal balance by that amount. They have to keep the principal balance what it is, and then when we pay it off, the escrow money can get back to you.
Yes.
So it could be a couple $1,000s depending on what it is. So when you're talking about refinancing and those escrow rolling or getting impounds again,
Mhm.
we're gonna say to you, go find out what your escrow balance is because that amount is gonna come back to you in the end.
Yes.
So, and
Yeah.
sometimes that's enough that it's like, oh, okay, maybe then I will come in with a couple $1,000s because I know I'm going to get it back anyways.
Yeah.
So,
Just
um,
having it make sense for you.
right. So, really,
I think you touched on everything.
I think, yeah, I'm looking over my notes because
Yeah.
make sure that I did touch on everything. I think that was pretty basic
Mm-hmm.
on it. And don't be afraid of a refinance. Let's look at the numbers. Let's see if it makes sense.
Yeah, they exist for a reason, and they do.
They do, yeah.
They can
And they're not
be very
always just
beneficial.
because I need to lower my interest rate
Mm-mm.
to get a better payment. There's other reasons to go ahead and do a refinance, and this is very much specific to each individual homeowner.
Mhm.
So give us a shout out. Let's see what we can do to maybe help you in that. And if we can't, and you're in the best loan, at least you know you're in the best loan.
Yep.
So I talked.
You did. If you have any questions, reach out to us, as Debbie said. And you guys have a great rest of the week.